It's Thursday, November the 17th, and it's a little chilly out there. It feels a little bit like winter.
It's winter. Enjoying winter. I like winter. I like winter clothes. I made light of growing up at 205 in Greenway in Greensboro with mom and dad, a family of 3 boys and 2 fantastic parents. Corporate punishment. When it was
corporal, I think.
Corporal.
You weren't in a corporation then, so
no,
probably was corporate punishment.
Yeah. Was part of our household when it was needed. And I heard my dad this morning when I was listening to what the St. Louis Fed chairman said.
James Bullard.
Yeah. Mm-hmm. When he talked about interest rates, I heard my dad's voice say to me, now this is going to hurt you more. No, excuse me. This is going to hurt me more than it hurts you.
And you know what? It never ended that way.
Never did.
Because I got the same speech from my father, and it never worked that way. It really hurt me a lot more than it hurt him.
But for me, it was deserved, I'm sure. And I learned from it. But what I'm trying to get to, Mr. Bullard this morning gave a zone, which is one of the first times I've seen him do that, of where he thinks, remember the terminal interest rate we've talked over and over about, where is that level that they can stop?
Where they can stop and then hopefully try to get it back to ultimately to 2%.
Well,
as the goal.
He said a dovish rate would be at the 5% range, and a hawkish rate, sit down, would be at 7%.
Now, considering the Fed has not gotten really anything right, I'm going to lean towards the hawkish
So Dad's words of hurting him more than me, I don't know what that means for us going forward, but I believe the pattern of the Federal Reserve increasing interest rates are going to continue.
Yeah, interpreting what he said, he basically said, what we've done so far has not done enough. In fact, it's not even close to have done enough. So they're going to be continuing to raise rates, which again leads to your anecdotal story about this is going to hurt you a lot, going to hurt me a lot more than it's going to hurt you. So I think we're in for more rate increases. It's already having a negative impact on parts of the economy. But then you look at the jobless claims, and they were down again today. So if the Fed wants to move the jobless claims up into the 6% range, and we're at 3%, that just tells me we've got a lot further.
We got a lot further to go. The other concern in the discussion about interest rates is that we're at 7.7% in inflation, and they wanted to go admittedly to 3. So I mean, we're up here and we got this. What happens if it gets sticky around 5?
Then they have to crank it a little bit more.
And that's not see, they're thinking that 7.7 goes down to 3 and there's the soft landing. I think you can remove soft landing. I think bumpiness keep the seatbelts on. But what the concern of the discussion is now, what happens if it gets sticky around 5? And what that really means is that the Fed is behind the curve, and they're going to have been, and they're going to have to catch up.
And so that's why it's going to be a rough landing. It's why we are bearish at the moment. It's why we're so cautious at the moment. It's why we're buying treasury bills. It's why we're just very reluctant to get into the market, because I think the market was off in pre-market trading. I haven't looked at it since it opened, down 300 points. So today could be a rocky day. But food costs continue to go up. Rental costs continue to go up. We're just seeing areas that are so impactful to you. That are not under control.
Now, today is a big day in a lot of our clients' accounts, in that one of the first rounds of treasuries is maturing mid-November. In fact, a lot of the dates I've seen is today. It'll settle. We'll get into next week. We'll look around, and in all likelihood, I would say we'll buy another 3 months. We'll get a little bit better rate. We'll look at it 3 months. Our next buy will come in January, because I've seen a lot of dates that are showing up in January, February. You and I said on the radio show to our listeners, we're just going to walk our way through the first half of next year and evaluate where we are be protective, be cautious, and grab yield in safe things that we figure is best.
There's a
for you.
3-month today, so that that rate changes on a daily basis, but the 3-month is around 4.25, and then the 6-month is around 4.6. So they continue to edge up, even with the good news of inflation being down from expected, 2 weeks ago, and we had the euphoria in the market. So we're just being very cautious. Jeff Bezos didn't help. Amazon at all didn't help really anybody's confidence by saying, if you're thinking about purchasing anything big, you ought to delay it, be very careful, keep dry powder. And this is the founder of Amazon, and basically telling you, no, don't buy things from Amazon. When you start to hear things like that, you start to really take notice that Christmas is probably going to, the continued greatness that we've seen over the last 8 years in that last quarter is probably coming to an end.
Now, it's not meaning that we ought to stick our heads under the sand and ignore it. We'll have opportunities in the 3-month treasuries. There will be opportunities in buying certain sectors. We talked about healthcare on the show today. We talked about energy on the show today. We're actively managing your accounts. We're staying in touch with you. We answer any questions you have or concerns you have. We're doing it. We're going to get through it. We're looking for the other side, which is not a train coming to us, but it is brighter days ahead of us, and we'll get there. But we do it because it is your money.
And your money matters. One last thing before we exit.
Yes.
We will not be here next Thursday, so you will not see a video next week.
So unless we just maybe might do a quick one to
We
say
could just happy Thanksgiving. Yeah, absolutely.
And we'll try to do that.
And if we don't, happy Thanksgiving.
Yeah. Take care, and we'll be back.